The NASDAQ stock market is currently closed, and as of the final trading bell on July 15, 2026, at 4 p.m. Eastern Standard Time, Rivian Automotive Inc. closed at exactly $17.80 per share, marking a modest intraday gain of 1.10% during the session. While the surface numbers suggest a quiet day of trading, the underlying mechanics inside the order books reveal an intense institutional battleground that completely upends what most retail participants assume about this business. The general narrative surrounding Rivian right now centers on its hard-fought battle to achieve scale, with retail boards buzzing about vehicle delivery metrics, manufacturing upgrades at its main plant, and the recent consumer rollout of its next-generation platform. However, the real story driving the smart capital is not the vehicles themselves, but a massive balance sheet recalibration that establishes a firm baseline for the asset value, while simultaneously threatening massive dilution. When a company executes a massive 75 million share equity offering to secure specific debt agreements, it draws a line in the sand that sophisticated entities respect, altering how this name compares to traditional retail favorites like Tesla stock, Apple stock, or Nvidia stock. To truly understand what is unfolding, we have to look past the standard retail sentiment found on common investing sites. The conventional expectation is that higher production and accelerating delivery numbers naturally lead to a surging equity price. The stark reality is that for an automotive enterprise fighting through the capital-intensive scaling phase, increased volume can actually accelerate cash burn if contribution margins remain negative. Retail investors logging into their Robinhood app or browsing through SoFi Invest often see a headline about a delivery beat and instantly buy shares, assuming the worst is behind the company. But institutional desks executing size orders on the Interactive Brokers platform look directly at the unit economics and capital expenditure requirements needed to scale compute for advanced driver assistance systems and hardware architecture. The market narrative presents this company as a sleek, independent alternative to legacy automakers, but the structural reality shows an enterprise deeply reliant on joint ventures and massive capital injections, such as its partnership with Volkswagen, just to sustain its long-term operational runway. This tension between what the public anticipates and what the cold data proves is exactly why daily volatility remains so pronounced. During the recent trading weeks, the volume profiles show a heavy accumulation pattern where large blocks are changing hands within a specific support zone. When you look at the activity on major electronic communication networks, it becomes clear that big funds are utilizing automated execution strategies to accumulate positions without spiking the spot price. Retail traders using a standard individual brokerage account frequently get shaken out by these multi-week consolidations, misinterpreting lateral price action as a lack of momentum. Meanwhile, long-term managers building out a core position through complex systems look at these levels as a strategic accumulation box. If you monitor capital flows through institutional channels, the massive options volume indicates that sophisticated players are hedging their long equity exposures with complex derivative structures, rather than simply buying or selling the spot asset. Let us break down the macro forces that are squeezing the entire electric vehicle sector. Higher interest rates have dramatically altered the math for consumer auto loans, which directly impact premium vehicle sales. When a consumer uses their Robinhood cash management features or standard bank accounts to evaluate a monthly vehicle payment, a high-interest environment forces them to reconsider luxury purchases. This creates a difficult headwind for premium electric trucks and sports utility vehicles. Furthermore, the broader markets are experiencing a rotation where capital is flowing away from highly speculative, unprofitable growth names and seeking shelter in cash-flowing giants, which is why a typical individual brokerage account might see massive outperformance in mega-cap tech, while early-stage automotive manufacturing names face continuous selling pressure. Consider how this looks to a standard long-term investor allocating capital through their financial advisor or utilizing automated systems like Schwab Intelligent Portfolios. When setting up an intelligent portfolio or seeking professional investment help, the algorithms typically favor balanced exchange-traded funds or stable cash-generating equities over high-beta automotive startups. For those engaged in self-investing or choosing to invest online, the temptation to chase the daily swings of high-beta names is strong, but without analyzing sector momentum and macroeconomic pressures, it's easy to get trapped at the top of a local cycle. The daily swings we are observing are heavily influenced by programmatic trading programs that trigger sell programs whenever macroeconomic indicators point towards sustained inflation or prolonged central bank hawkishness. Comment below how many shares of Rivian Automotive Inc. you currently hold in your portfolio and whether you are buying more at these levels. Looking closer at the internal corporate structure, the business model relies heavily on its proprietary platform architecture. The company operates a direct-to-consumer sales model alongside a dedicated commercial vehicle segment, which includes its highly publicized contract to supply custom electric delivery vans to Amazon. This dual-track approach was designed to provide a stable, predictable revenue stream from commercial clients, while captured consumer margins would drive long-term profitability. Historically, the company grabbed global attention during its massive initial public offering, raising billions and briefly achieving a market capitalization that rivaled century-old automotive giants, before delivering a single meaningful batch of customer vehicles. The past performance reports reveal an organization that excelled at engineering but severely struggled with supply chain logistics, component bottlenecks, and the sheer physical friction of factory floor optimization. When analyzing past financial statements, the net losses have been staggering, often measured in billions of dollars annually, as the firm burned through its massive initial cash pile to retool production lines and establish service networks. For anyone tracking their long-term wealth through Fidelity Investments, looking at the historical net income charts of this asset can be sobering. If you look at your Fidelity brokerage or manage capital within Fidelity IRAs, you know that sustainable businesses must eventually transition from burning capital to generating positive free cash flow. While retail investors focus on the design praise their consumer vehicles receive, analysts using the Interactive Brokers platform are staring at negative gross profit margins, calculating exactly how many quarters of runway remain before the next capital raise becomes mandatory. This brings us back to the core divergence between expectation and reality regarding the recent equity offering. The market initially reacted with sharp disappointment when the company announced the capital raise, causing the stock to drop significantly in a matter of days as traders feared immediate value dilution. The common expectation was that the company was running out of operational options. The deeper reality, however, is that this capital raise was a highly tactical move required to meet the strict co-investment conditions of a multi-billion-dollar government loan intended to fund their new manufacturing facility. By securing these funds as restricted cash, the company reassured government lenders while preserving its unrestricted balance sheet cash to focus entirely on scaling its upcoming, more affordable vehicle lines. This structural safeguard changes the entire risk profile, yet many retail participants trading on the Fidelity mobile app or checking their portfolios during lunch breaks missed this detail entirely, focusing only on the negative headline. If we look at the competitive landscape, the comparison to legacy operations and other pure-play electric manufacturers is striking. Many retail participants utilize their standard accounts for online investing or look for online investing opportunities across various investing sites, assuming all electric vehicle companies will move in lockstep. However, the operational reality shows a wide divergence in execution. While some early-stage players are facing severe distress, this specific manufacturer has built a strong wall of institutional backing and joint venture validation that protects it from immediate insolvency risks. The partnership with global automotive entities provides not just capital, but vital software architecture support and shared development costs that significantly reduce the long-term financial burden of developing advanced computing platforms. For the modern investor engaging in self-investing or building out a portfolio via SoFi investing, comparing this asset to peers requires looking at production scale. The manufacturing facility in Illinois has undergone significant shutdowns and retooling efforts designed to clear production bottlenecks and introduce new drive units that cost significantly less to build. The expectation was that these upgrades would immediately result in higher output and a soaring stock price. The reality